Welcome to The Explainer. Today, we're diving into something truly fascinating, the Swiss real estate market. I mean, this is a market that seems to play by its own rules, almost defying gravity. So we're going to unpack exactly what makes it such a unique global puzzle. So let's jump right into the big question, shall we? In a world that feels pretty uncertain economically, how does the Swiss property market just cruise along? We're going to see it's this potent cocktail of economics, policy, and just plain scarcity that sets it apart. Okay, so to really get this, you first have to understand the massive economic shield that basically protects Switzerland from all the turbulence out there. And no, it's not just about mountains and banks, It's about a foundation that is just rock solid. Just look at these numbers. I mean, compared to almost anywhere else, Switzerland has this incredible combination of steady growth, a really healthy job market, and get this, basically zero inflation. While everyone else is fighting rising prices, that super strong Swiss franc acts like a buffer, creating this uniquely stable playground for everybody. And here's where it gets really interesting. Look at what the central bank did. Because inflation was so low, they just slashed their key interest rate all the way down to 0.25%. And that move, well, it unleashed this powerful double whammy stimulus on the property market. It's brilliant, really. You get this two-sided effect. For regular people, mortgages become insanely cheap, so buying a home suddenly looks way better than renting. And for the big players, the institutional investors like pension funds, well, with government bonds paying next to nothing, property starts looking like a much, much tastier place to put their money. It's like pouring fuel on the fire from both the top and the bottom. All right, let's get to the real heart of the issue. This is where that supercharged demand we just talked about, well, it smashes head-on into a chronic, almost immovable lack of supply. This is where the real drama is. So on one side of the equation, you've got money that is just historically cheap. I mean, think about it. Locking in a mortgage for 10 years at around 1.6%. That makes buying a home affordable for so many people. It's the engine driving that unstoppable demand. And on the other side, you have this. A supply that has practically vanished. This number it's just mind-boggling. In a major global city like Zurich, the vacancy rate is 0.07%. Let that sink in. For every 10,000 apartments, only 7 are free. We're not talking about a housing shortage here. We're talking about an extreme, critical lack of housing. And what you get is what we can only call a market sweet spot. Is this perfect storm, right? A collision of massive demand, juiced up by cheap money, hitting a wall of incredibly limited supply. That dynamic right there, it supports prices and basically defines the entire market. So with all that going on, where on earth do you even start to look? The Swiss map can seem a bit complicated, but we can break it down pretty simply by thinking about 3 different kinds of investors based on where they'd buy. This table really lays out the fundamental choice, doesn't it? Do you want the absolute rock-solid stability you get in a place like Zurich, even if it means lower rental income? Or do you go for a secondary city like Fribourg, trying to balance growth with better yield? And then there's the third way, the unique lifestyle investment. Maybe a place in the Alps for a totally different kind of income. Each path has its own flavor of risk and reward. Now, of course, you can't just look at a map without knowing the rules of the road. And for any international investor, the big one is called the Lex Koller. The short version? It's a law that limits who can buy what. So if you're a foreigner who doesn't live in Switzerland, your options are pretty restricted, especially for things like holiday homes. But, and this is a big but, if you're from the EU and have Swiss residency, or you've got a C permit, these rules mostly don't apply to you. Okay, so once you've picked a spot, what do you actually buy? This is where things get strategic, because the type of property you choose, and whether you renovate it, opens up some really smart angles, especially when you start looking at taxes. What's happening in the apartment market is that it's basically splitting in two. You've got huge demand for small places, think students, young professionals, downsizing seniors, and that's where you get the best rental yield per square meter. Then, at the other end, you have massive demand for large, family-sized apartments, which are becoming incredibly rare. That scarcity is valuable in its own right. You can really pick your strategy and target one side or the other. Now, if you're thinking about renovating to add value, you absolutely have to know how the taxes work. It's crucial. Swiss tax law is very specific. It splits your costs into two buckets. Simple repairs and maintenance, that's value preserving, and you can deduct those costs from your income right away. But big upgrades that add new value, like adding a whole new room, generally you can't. But here is the secret weapon, the game changer for any renovator. Even though things like new insulation or a modern heat pump clearly add a ton of value, they get treated as value-preserving maintenance. What does that mean? It means they are fully tax deductible. It's this fantastic incentive to go green and save big on taxes at the same time. So let's put all this together into a clear, straightforward playbook. We can boil it down to 3 distinct strategies you could use depending on what your goals are. We'll tie together the location, the property type, and even the type of mortgage. So here are your plays. Strategy 1 is all about safety. You buy in a top-tier city like Zurich and lock in a long-term, fixed-rate mortgage for peace of mind. Or strategy 2, you go for a balance of growth and income in a city like Fribourg, maybe with a more flexible hybrid mortgage. And finally, strategy 3 is for the risk takers. You go for a value-add play, renovating an older place, focusing on those tax-friendly energy upgrades, and using a flexible mortgage to do it. And that brings us right back to where we started, to the heart of this whole puzzle. It really leaves you with one final thought, doesn't it? In a global economy that is just so volatile and unpredictable, maybe, just maybe, the most valuable return you can get from any investment is simply a safe haven. And that might just be the answer to the Swiss real estate puzzle.